One of the ways to enhance your stock portfolio is to invest in the highest dividend-paying stocks. They indicate companies with financial stability. Dividends you earn on the stocks can be an additional source of income. When you hold dividend stocks, you can make money while you sleep. With dividends, you can make money without working. So, in today's video, we are going to talk about the best dividend stocks for 2023 and beyond. The video is going to be amazing, so make sure you stick to the end. Lowe's low, 2.09%. The home improvement giant may not seem like a very exciting stock. And that's true unless you like dividend growth. The company has raised its dividend every year since going public in 1961 and has raised the payout a massive 556% over the past decade alone. For investors worried about the housing downturn that began in the second half of 2022, don't fret. People are more likely to invest in the home they have when the housing supply is tight and it's harder to buy. Another important number that's good for Lowe's: the typical U.S. home is between 31 and 60 years old, depending on the state. The next generation of buyers will spend a lot of money at Lowe's. Johnson & Johnson, J&J, 2.95%. Johnson & Johnson owns a portfolio of excellent brands that make products people need, specifically healthcare items. In addition to its well-known consumer brands, Johnson & Johnson has massive and steadily profitable operations in pharmaceuticals and medical devices. The combination has allowed the company to increase its dividend for 60 years in a row. This diversity across consumer health brands, pharmaceuticals, and medical devices is unmatched and has proven to be a massive profit engine. However, management thinks this conglomerate structure has limited the company's ability to focus its resources and announced plans in late 2021 to split the consumer products business into a separate company. The split is on track to happen in 2023, with existing shareholders receiving shares in both companies. Tyson Foods Incorporated, TSN, 3.28%. Tyson Foods is a consumer staples company that produces meat products. That made for a tough 2022. The price of proteins went up considerably amid last year's inflationary commodity market conditions. Meanwhile, as Tyson primarily is a low-margin commodity meat seller, rather than having higher value-added branded goods, it wasn't able to fully pass along these higher prices to consumers. Amid slumping profit margins, Tyson's stock price sank. However, these cycles in the meat industry are common and pass with time. Tyson's profitability should recover as the economy stabilizes. While earnings are expected to be down sharply in 2023, Tyson is trading at just 9 times forward earnings. In addition to the dividend, Tyson shares also offer considerable value on a share price basis. Annaly Capital Management Incorporated, NLY, 17.29%. Annaly Capital Management Incorporated is a diversified capital management company that operates as a real estate investment trust. It has investments across the mortgage finance industry. Its investment portfolio includes agency mortgage-backed securities, MBS, residential real estate, and mortgage servicing rights. Before we move on, support us by hitting subscribe and the bell icon to get notified when we post new videos. Now let's get back to our topic. Rhythm Capital Corp., RITM, 11.01%. Rhythm Capital, formerly known as New Residential Investment Corp., is a public REIT investing in the residential housing sector. The company's portfolio includes mortgage servicing-related assets, residential loans, non-agency securities, and similar investments. The company announced the change in its name and stock ticker in June 2022. International Business Machines Corp., IBM, 5.15%. For many years, IBM didn't look like one of the best dividend stocks to buy. After all, newer software and cloud companies were soaring, while IBM appeared to be left behind. The tides turned in 2022. IBM managed to deliver a positive total return last year, even as most tech stocks sold off sharply. What explains the change in sentiment? For one thing, after years of declining revenues, IBM has returned to growth. The firm's bold Red Hat acquisition has given life to its cloud business. At the same time, investors are now focusing on companies with strong profitability and cash flow generation instead of prioritizing future growth. While IBM is not growing too quickly, it checks the right boxes for investors focused more on current profitability. The stock has some upside if IBM can keep nibbling at the market shares of bigger cloud computing providers. Taiwan Semiconductor (TSM), 2.11%. Taiwan Semiconductor Manufacturing is a Taiwanese technology stock with a 2% dividend yield. The dividend on this stock isn't very high, but it has a lot of potentials to grow. Unlike many other chip stocks, TSM is still growing this year. In its most recent quarter, its revenue increased by 43% and its earnings increased by 78%. It's an incredibly strong showing, made even more impressive by the fact that other semiconductor companies mostly had negative earnings growth in the same period. All this earnings growth can lead to dividend growth in the future. So that's it. Please like, share, and comment your thoughts below if you liked this video. Remember to subscribe to see our next video.